a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Meena Mishra, and today we are talking about small cap ETFs. And we know that stocks have started rebounding after a brutal first half because some investors believe that the sell-off could be reaching a bottom. And in recent inflation reports were much cooler than expected, and that is seen as good for stocks. Now, small cap stocks, which were beaten down earlier, they are outperforming the S&P 500 index since mid-June. In fact, the Russell 2000 index has surged almost 22% since then, whereas the S&P 500 index is up about 17%. And this comes after the small cap stocks index underperformed because investors worried about the health of the economy, and these were beaten down. But now it appears that a lot of bad news has already been priced in the small cap stocks, and after the sell-off, their valuations look quite attractive. So the S&P 600 small cap index is currently trading around 13.5 times forward earnings, whereas the S&P 500 index is trading at about 19 times forward earnings. And also these companies have a lot of domestic exposure. And since the dollar has surged this year up more than 10%, that impacts the earnings of big companies that have a lot of overseas exposure, and that does not impact the smaller companies, which are mostly domestically oriented. And also the US economy, even though it is expected to suffer a mild recession, it is still expected to do much better than the rest of the world. We know that European economies will suffer because of their reliance on Russian oil and gas, and emerging market stocks are also suffering because of the surge in energy and food prices. So the US economy is expected to do better, and that will help these small companies. We have also seen that consumer spending has shifted from goods to services. That helps smaller companies because those are mainly services provider. And then there is some research which shows that small cap stocks tend to outperform in the early stages of a market rally. That is according to Ned Davis research, because we know that the Fed rate hikes, the tightening campaign, that may land the US into a recession, but the recession is likely to be mild according to most experts. So these small companies, they tend to lag earlier when the economy heads into a recession, but they start outperforming midway through recession. That is according to RBC Capital Markets, because we know that markets are forward looking, so they price what is coming in the coming months. But at the same time, investors should remember that these smaller companies are riskier than larger companies. Please remember that, and the exposure should be according to your risk tolerance. Now we'll take a look at 4 small cap ETFs. 2 are very popular, 2 which follow slightly different methodologies and have done quite well compared to the broader ones in the last 1 year. So the first one I'm highlighting is the most popular and one of the cheapest small cap ETF. The ticker symbol is IJR, and it tracks the S&P small cap 600 index. So as the name suggests, it has about 600 holdings in market cap weighting, and very popular with 72 billion in assets, and ultra cheap with expense ratio of just 6 basis points. So to learn more about this ETF, let's go to the quote page on Zacks.com. You can read our research report, articles, and you can go using the link. You can go to iShares webpage for the CTF, and you can see what exactly it holds. So, Agri Reality, Reed Corporation, L Services Holdings, UFP Industries. These are the top holdings in the ETF, and in terms of sector exposure, financials, industrials, and then technology and consumer discretionary in terms of sector. Now, the second one that I'm highlighting is also very popular, and this tracks the ultra popular Russell 2000 index, which Russell 2000 index is seen as representative of smaller cap companies. And as the name suggests, it has 2000 holdings from the US small cap universe. This is also market cap weighted, very popular with 58 billion in assets. It's slightly pricier compared to IJR, 19 basis points, but still very cheap. And again, let's go to the quote page on Zacks.com, and from there, the external home page, and see what exactly the CTF holds. So you will see that Shockwave Medical, Biohaven Pharma, Karuna Therapeutics, these are the top holdings in the ETF. You will see that you get a different exposure. Healthcare is the largest sector in terms of exposure, then financials and industrials and information technology. So this is a more diversified ETF, and the sector exposure is also different. Now, the third one that I'm highlighting is this holds the quality companies within the Russell 2000 index. These companies that have grown, that have paid, and also grown their dividends for more than 10 consecutive years. So the ability to pay consistently and also grow their dividends, that indicates the quality of the balance sheets of the company. So with this ETF, you get exposure to high quality companies within the small cap universe. This follows an equal weighting scheme, has about 100 holdings, pricier with 40 basis points expense ratio due to its niche exposure, and has about 820 million in assets. So let's go to the quote page on Zacks.com, and again, using the link, we can go to the external home page. So this holds companies that have not just paid but also grown them for 10 consecutive years. Looking at the holdings, you will see Mercury, General Case Aluminium, Southwest Gas. These are the top holdings in this ETF. Now, the last one that I'm highlighting is by Invesco, and this holds the purest value companies within the S&P Small Cap 600 universe. It's very strong value characteristics. So it selects 70 holdings and selects as also weights them on the basis of their value score. This is the smallest of the four that we discussed, 295 million in assets, and charges about 35 basis points. Again, to learn more, you can go to the quote page on Zacks.com, and using the link, you can go to the Invesco web page. So this uses price to value, earnings to price, and sales to price ratios to determine value, and then selects the holdings on the basis of strongest value. So consumer discretionary, financials, and industrials are the top sectors, and you can look at the holdings: BBF Energy, Olympic Steel, Seneca Foods, and Mercer International. These are the top holdings in this ETF. Now, on the next slide, I have the comparative performance over the past 1 year. So you will see that the Invesco and ProShares product have beaten the other ETFs, and in full disclosure, I own those two in the ETF investor portfolio that I manage. The Russell 2000 ETF is the worst performer. The other one has delivered performance similar to the S&P 500 index. On this slide, I have the year-to-date performance. You will see that the two Invesco and ProShares products have again beaten, and the other three have delivered almost similar performance year-to-date. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and also make sure to subscribe to our videos, and I'll see you next week.